In 1986, the United States Congress buried 4 sentences inside a 900-page tax bill, a provision called Section 831B that let a private company insure itself and pay almost no tax for doing it. And to this day, no one in Washington will tell you why it was written to stay hidden. Here's the ordinary version first. A business buys insurance. A company sells it. Simple. But somewhere in the fine print of the Tax Reform Act of 1986, lawmakers carved out an exception for what they called small insurance companies, outfits collecting less than a set threshold in premiums each year. Those companies wouldn't pay tax on the money coming in, just on what they earned investing it. It sounded like a favor for tiny rural insurers in Iowa and Nebraska. Nobody objected. Nobody even noticed. It passed. And for almost 20 years, it sat there in the code, untouched, unnoticed, waiting. Then something happened that the provision was never supposed to allow. Business owners, dentists, real estate developers, manufacturing families started forming their own insurance companies, not to insure strangers, to insure themselves. A man who owned a chain of car washes could create a captive insurer, pay it premiums out of his own business, deduct every dollar and watch the money grow inside the captive completely untaxed. He was, in effect, insuring against risks that barely existed: a flood in the desert, a lawsuit that would never come, and the IRS allowed it because the law never said the risk had to be real, just that the paperwork looked right. By 2015, thousands of these captives existed. Estimates put the sheltered wealth in the billions, and almost no one outside a small circle of insurance attorneys knew the mechanism existed at all. The official story is that this was working as intended, a relief valve for small businesses that couldn't get affordable coverage from the big carriers. That's the line regulators gave for 2 decades. But that explanation falls apart the moment you look at who was actually using it. These weren't struggling small businesses buying coverage they couldn't otherwise get. They were wealthy families using captives as estate planning tools, moving money to their children tax-free under the cover of an insurance company that rarely, if ever, paid out a claim. In one tax court case, a captive collected millions in premiums over several years and paid out a grand total of nothing. Not one claim. That's not insurance. That's a vault with a fake name on the door. Now watch what happens next, because this is where it gets buried for real. In 2014, the IRS quietly placed 831B captives on its dirty dozen list of tax scams, a list most Americans have never heard of, tucked into a press release nobody covered. Not banned, not shut down, just flagged in language so soft you'd miss it if you blinked. Congress then raised the threshold in 2015, letting even more premium dollars flow in tax-free, in the very same bill that claimed to be tightening the rules. Enforcement actions trickled out one at a time, a promoter here, a family fine there, never a public reckoning, never a hearing that made the evening news. Court records from the era show the IRS itself struggling to calculate how much revenue the provision had actually cost the country. Because the filings were so opaque, even the agency chasing the money couldn't always trace where it had gone. Remember that fine print from 1986? The same 4 sentences that were supposed to help a handful of small-town insurers had, by the 2010s, become one of the most quietly effective wealth transfer tools in the tax code. And it stayed that way because almost no one was ever meant to look closely enough to ask. What this means is bigger than one loophole. It means a law can sit inactive for decades, invisible to the public, until the people positioned to exploit it, the attorneys, the accountants, the family offices, find the seam. It means enforcement doesn't announce itself. It leaks out through tax court opinions and press releases timed for a Friday afternoon. And it means the families who used captives this way weren't breaking the law. They were using the version of the law that was written, quietly, for someone. The rest of us just never found out we were supposed to ask who. Some of those captives are still open right now, filed under names that sound like ordinary insurance companies, sitting in states that don't require much disclosure. The IRS still doesn't have a full public accounting of how much has moved through them since 1986. So the question isn't whether the loophole existed. It's this: how many are still open today, quietly collecting? And what happens the day someone finally counts them all?